Made here with another video. We're going to be doing another not financial statement analysis. I need to stop making that mistake. We're doing another stock market analysis today, and I've already pre-looked at the stocks just so I can be a bit smoother in this video. I think it helps, but I'm not going to tell you beforehand whether or not I've managed to find any stocks. But without further ado, let's look at the top losers and the top winners. So first, we're going to look at the top winners. So we're looking for 1 billion in market cap. Ideally. So if you're unfamiliar with my videos, so what the stock market analysis is, we look at the top losers and top gainers for the day, and we ideally choose from the top losers because those are the cheaper stocks. Well, those tend to be the ones that have decreased in value. So if we pick from that pile, then we're more likely to find a stock that has decreased in value, and more likely to find a stock that's cheaper than it would have been. So the market cap for this company Biffa is just under 1 billion, so we can excuse that. We can excuse the minor difference in price. So revenue figure is just over 1 billion, and the total assets is 1.42 billion. So overall, looking good in terms of revenue and net profit. So let's look at the net change in cash: negative 57 million, 21 million, and 25 million. So about zero for the past 3 financial years, excluding the current. The balance sheet shows a 67% debt asset ratio, which is just above what we're looking for, around 50%. So it's not too bad, but it's a little bit on the high side. But the main thing is the profit margin. So the profit margin for the past 3 years has been very, very low or negative. Last current financial year has been negative. The previous 2 has been very low. So for this one, I would say we would avoid it. Also considering that it's gained 27% today. If it hadn't, then probably it'll probably be a more viable investment. So we're gonna avoid this one. So this one I've already checked. Is actually too small. The market cap is way too small. So we're gonna avoid this one. I'm gonna skip the long positions. And we're gonna go to SGL Carbon. 719 million. Decent profit margin for the last current financial year, but the prior 2 were negative. So debt asset ratio is also very high. We're going to skip that one. Global Bioenergies, so 67 million. We're going to skip that one. Bemil, we're going to skip that one because it doesn't have any financial information. And the last 2 are 3 times long positions of Uber. So let's go into the top losers, see if we can find any bargains. So Ted Baker's here. This one also, the market cap is too small. I was actually shocked because I thought Ted Baker, knowing that it's a reputable company, I thought that the company would have a larger market cap and just in general a larger size, but it's actually quite small. Its size is less than £500 million. Anyway, we're gonna skip this one because this company is too small. Long position, long position, long position, long position. KBC and Oka. I'm gonna check this one. 3.25 billion, which is good. Wow, those profit margins are off the scale. Consistently amazing profit margins. I'm not sure how we got that so high a profit margin. It's quite unusual. So we'll have to check as to how it managed to obtain those profit margins. So that's SG ratio is incredibly low, which is good. Let's just check the net change in cash for the past 3 financial years. 2.3 million net change in cash, 60 million net change in cash, and negative. So it's about 40 million net change in cash positive for the past 3 financial years, which is really good. I'm not too sure how I got these profit margin figures. So let's just check. Revenue 34 million. Cost of revenue is 13 million. Revenue, yeah. So gross profit is 20 million. Total expenses 490k. Operating income 519. Net income before taxes. Income available to common extraordinary shares. Diluted weight average shares. Diluted. Yes, it's very strange. Yeah. Let's just check this one. The prior financial year. Operating income 60 million. So the revenue figure is 77 million. Total cost of revenue. So net gross profit is 63 million. and the operating expense is 2.2 million. Operating income is 60 million, and after taxes, so it doesn't pay much. It didn't pay any taxes. Net income is 60 million. So compared to total revenue, just under 100%. Yeah, it's crazy. Just under 100%. Yeah, that's quite crazy. So it doesn't pay much. It doesn't pay much taxes. Interesting. Maybe I don't know. Maybe they're deferring the taxes. I don't know. So maybe in the next financial year, the succeeding financial year, they'll pay a lot of tax. So anyway, let's go into. Actually, we're gonna add this one, KBC Anoka, to our. But it does earn quite a small amount of profit and revenue compared to its market cap, which is very strange. Which does that mean it's very expensive? Let's just check its PE ratio. Yeah, the PE ratio is very high, 186. That's probably why. So people have probably seen these profit margin figures and just swarmed on the stock and bought lots of them, lots of stocks. Yeah, so we're gonna avoid this one because the PE ratio is very high. So it's very expensive. KBC and Oka. So the rest of the stocks are not necessarily pure stocks. They're just multiples of long positions. So we're gonna avoid the rest. So guys, I hope you guys have taken some value out of this video and my previous videos and future videos. Specifically, the process I use to identify good stocks, cheap stocks, and yeah, I hope you guys got some value out of these videos, and I'll see you in the next one. Thanks, peace.